Good day to all. This is our second part for cash, payables, and liquidity management. Make sure to watch the first part in this channel. Accounts payable management would involve certain items as follows. First is the definition. This would involve the time of or from purchase of raw materials until payment is placed in the mail by us, the buyer or the customer or client, to the supplier, or basically us, the payor, and the supplier, the payee, as explained in the previous video, payor versus payee. And then this also includes the float and the clearance of the float, because payment is officially done when it has been transferred officially also in the bank account of the supplier. So for AP functions, we have to examine all incoming invoices and determine the amount to be paid. As a rule, though, we should make sure that we are able to pay on time to avoid other unnecessary costs and to avail of any discounts as much as possible. For control function, meaning to control the AP, cash manager verifies that invoice information matches purchase order and receiving information. Very true. Before we pay anything, we have to make sure that there are supporting documents. We have the purchase order or the PO. We have also the receiving report or the delivery report. So receiving report, of course, our receipt of the inventories or goods in good condition, of course. Then also with the delivery receipt or report, perhaps of the supplier or seller. So a copy of that. Then the invoice. So invoice and the billing statement sent to us by the supplier. Now we have to decide between centralized or decentralized payables and payment systems. If we say centralized, meaning to say for a certain group of companies, there's only one company or one area, specific department that will be processing all the payables and payments. However, for decentralized, it will depend if, for example, a certain branch or a certain group, or let's say a unit of the group of companies, would be allowed to process payments. Now, normally there wouldn't be a strictly centralized or strictly decentralized. It would depend, but in modern organizations, normally it's going to be geared towards decentralized, meaning to say that the branches, the respective units under the group can process the payments. Now, centralized payment systems allow better control. This is a good realization. However, they have slower payment times. That's true. Because if a certain branch would like their payments to be processed, they still have to subject themselves to the approval of the authority or the authorities in the main office. And then we compare this with decentralized. So decentralized, there could be a lesser advantage in the control, but faster payment times. How do we solve that before we go to cash discounts? Going back. Anyway, what we can do now is to achieve the balance. So there should be principles of check and balance for decentralized. We make reports, we submit reports to the main office, or the main office would still be signatories at the end of the day. Now, cash discounts, as what we've said, should be availed by wise management. On the part of the supplier or seller, this is to encourage the customers to pay early. On our end, as the buyers and the payors or payers, we are going to pay on time to be able to save. Now, to do the analysis on financial management perspective, we have to compare cash discount to short-term financing rate that is available to the firm. So this is our formula, because normally our respective option would be that if ever we are going to avail the discount, and then with that we are going to make a short-term financing, or what we do is that we are going to delay our payment really, and with that the R discount would be the rate of the firm, or if the firm does not take cash discount and pays at the end of credit period. Because remember, during those time that we do not or we did not pay, we can still make use of the money. So that's the point. So it's either we avail the discount and then we borrow money because we paid early, or what we can do is to not pay early and then we're going to make use of that money. So the formula for the rate of discount if we do not pay within the credit period is this: equals D, which stands for the percent of discount in decimal form, over the quantity 1 minus the percent discount multiplied by 365. This is the number of days in a year, all over the quantity CP, which is credit period, minus the DP, which is our cash discount period. Or by the way, this is DP. Okay, so CP, credit period, let's say 30 days, and then the DP would be the time from day one that we can avail the discount. So the difference would be the undiscounted period, or the period that we cannot avail or we do not avail of the discount. So we also have to take note that another assumption is payments are made at the last day of the payment period. Otherwise, we cannot make use of this analysis. So this would be a versus example for this one. So we have here Mason Industries, in which it has changed its terms from net 30 to 210 net 30. Amount if the payment is made within 10 days from the beginning of the credit period. Now, this is the usual thing. For those who are done with accounting for merchandising operations, this is the usual setup. So 210 net 30 is going to mean that if we pay from the first day to the 10th day, we can avail of the 2% discount. If we pay beyond that, so 11th to 30th day, then there is no discount. So that's one thing that we should remember about this. Now, if just net 30, so of course, no discount then. Mason has a line of credit with a bank with an interest rate of 6.75% per year. So if we avail of the discount, then we can borrow money from the bank. First, we have to compute the discount rate should we, for example, avail of non-payment, or we do not pay our respective due within the discount period. So this would be our formula. The discount rate is equal to D over 1 minus the quantity times 365 over the quantity CP minus the DP, in which we corrected the formula a while ago, and substitute our respective rates. So that's 0.02 over 1 minus 0.02 times 365 over 30 minus 10. And that would be equivalent to or equal to 0.372 or 37.2% approximation to 10th decimal place, and then per year. So if we do not avail of the discount and make use of whatever money that we have, then in that sense, the discount is going to be at the rate of 37.2%. However, if we avail of the discount, then the bank charges, of course, would be 6.75% on top of or on the 2% discount. So Mason should take the cash discount and obtain short-term financing by drawing on its bank line of credit, because it's just 2%, and then we can actually compute that as follows. So just actually compare 37.2%. We are not going to avail the discount versus 6.75%. So if we are going to take the discount and borrow money, that's well off. 6.75% is much lower than the previous. Now, another topic would be on the disbursement, products, and the method. So we have ways of making sure that we pay on time as the debt or financial obligations would be due, and making sure that we are able also to maximize the float. So one of that is ZBAs, which stands for zero balance accounts. So disbursements accounts that always have end of day balance of zero, which is clear. allows the firm to maximize use of float on each check without altering supplier's float time. Well, we have again our floats as discussed on the first part. So we can make use of that if we pay by check, because normally checks would have also processing period or time. Then in addition to mailing, but then mailing is not necessary, but let's just say the delivery time, that could be another float or delivery float or time float. And then keeps all cash in interest bearing accounts. So that's also one characteristic of that. Another one is controlled disbursement. From the term itself, the disbursement is controlled by the company because bank provides early notification of checks presented against a company's account every day. So there's really a daily update of that. On US or in US, Federal Reserve Bank makes 2 presentments of checks to be cleared each day for most large cash management banks. That's the control there. Another one is positive pay. Company transmits a check issued file to the bank when checks are issued. Check issued file includes check number and amount of each item. So another one is for that. Let's go back. So this is used for fraud. Okay. So this is also one thing that we should remember about positive pay. And we have here again, so we minimized our slide so that we can see the sentence at the bottom. So once in a while, we can do this, or we will do this. Why is this going to prevent fraud or used for fraud prevention? Remember that check issued file is transmitted when checks are issued, and the file contains already the check number and the amount of each item. So in that case, we can really verify the amount if we are on the part of the bank, or the bank and the company can work hand in hand to prevent fraud. All right, so to continue, another aspect of disbursement procedures, there are developments now. First is integrated or comprehensive accounts payable. In this case, the accounts payable or disbursements operations are outsourced. There are now companies who are or that are actually doing the jobs. So they are to be paid for certain fees. That could be another situation. Next would be purchasing or procurement cards. Increased use of credit cards for low dollar indirect purchases. With this, we can actually use or maximize debt financing. Next, imaging services. Both sides of the check as well as remittance information is converted into digital images. So in that case, that could be resulting to easy transfer of information. However, the concern will be the security of the exchanged information. So with that, if we are in US, we really have digital signatures that we can actually make, such that if the information shared via or by email contains certain digital signatures, then we can make sure that the information would be actually authentic or genuine or verifiable. Next would be useful when incorporated with positive pay services. Remember a while ago, we actually have the file. Let me go back to that. So file being shared, the check issued file containing the check number and the amount of each item. So in that case, that could be used also for the positive imaging services, and then also with the positive pay services. All right. So it's like the combination already of the sharing of information online plus the check issued file containing the critical information. So imaging is basically on the conversion of the information into digital form. So that's the thing. Next is fraud prevention in disbursement. So with this, there has to be written policies and procedures for creating and disbursing checks. Then we have to separate duties: approval, signing, and reconciliation. These are incompatible tasks, duties, and responsibilities that have to be separated or segregated in order to minimize chances of fraud. Then also with this is the usage of safety features on checks like setting maximum dollar limits. So normally if we do, for example, pre-authorization, as explained a while ago, like the company will agree with the bank that a certain amount can be processed prior to the company being given information. So even before that, the bank can process the said payment or disbursement because it's part of the agreement. So with that, if it goes beyond that amount, then the company has to be notified. And also requiring of multiple signatures. Let's say we use that in combination of the maximum. So if we go beyond this amount, let's say 100,000 pesos, then there has to be at least two signatures or two signatories. But below that, one is okay or fine. It will be an or. So those could be ways of preventing fraud for the disbursements. Now, another thing would be, which was mentioned already in the prior video, about surpluses or excess cash. So in that case, we can also make use of that for short-term investing. Again, within the banking days of 90 days or less, so that we can convert them into cash immediately, and any changes of value would be insignificant, unsubstantial, and immaterial. So near cash assets like marketable securities and other cash equivalents explained in accounting standard IAS 7 and other discussions from accounting and finance. For criteria for selecting marketable securities, that would be liquidity, mean to say that we can make use of that to pay currently maturing obligations and to preserve our principal. So we have to make sure that the values would be insignificant and changes would also be insignificant. Now, money market mutual funds. We have the usage of that, especially by smaller firms. And then funds set the net asset value or NAV at a fixed $1 per share to preserve the principal value of the firm. So the lesser, the better for the value of the net asset, and then offered by independent companies and most large banks. And it seems that it is affordable for those who are starting about such, and because the values are not moving, again, fixed. So it's much better for short-term investing focus and purpose. Now, short-term financial instruments would be in US. We have the US Treasuries T-bills or Treasury bills, in which the company or the US Treasury, I view that as a company still, or a department, would be issuing financial instruments so that such will have funds. So in essence, that would be a debt instrument on the end of course, the, let's say, US Treasury. That's also one viewpoint. On our end, if we are, for example, the investor of the T-bill, we can treat that under Philippine Accounting Standards 7. If we purchase, for example, at least 3 months or less from the maturity date, then that's going to be part of our short-term marketable, or let's say cash equivalents, to be more specific. Again, we have to oppose short-term investments, which are a year or less, but more than 3 months, to cash equivalents or marketable equity or securities of, to be more specific, 3 months or less. All right. So for T-bills, maturity less than 1 year, issued on a discount basis. As much as possible, we have to acquire such 3 months from the date of maturity. Then treasury notes and bonds are suitable short-term investments as they approach maturity because they are long-term in perspective. So if they are close to 3 months or less, they can be part of cash equivalents or near cash. Then federal agency issues have issued or have been issued by government-sponsored enterprises. And we have our bank financial instruments like the certificates of deposit and the bank deposits and bankers acceptances. So these bank financial instruments are also allowed. So contract between us, the depositor, and the bank, but the money should be available 3 months or less. Not necessarily like transactional, in which we can withdraw on a daily basis. So that's another thing. We can have like the savings or the checking account for that. These are other things normally being kept or set aside for certain period of time, but then 90 days or less to become near cash. Corporate obligations also, for corporations, they can issue debt instruments and you can become investors. However, normally the trend is on corporate bonds in which they're long term. So if we have short term corporate bonds being acquired and we have the 3 months or less period from maturity date, then we are okay with that. So some corporations, though, could be issuing commercial paper. So in essence, that's a short-term financial obligation. But then again, it should be 90 days or less to become near cash. Adjustable rate preferred stock, dividend rate paid adjusted according to some rate index. Now, these preferred stocks should be redeemable, mean to say we are also a corporation and then we issue, for example, shares. If preferred, such should be redeemable. That's part of the contract. Otherwise, we have to take note that all stocks or shares, like the preferred and ordinary, do not have maturity dates. Therefore, they cannot be part of cash equivalents. That's a discussion in IAS 7. However, for this part here, if redeemable, meaning we have to buy back that, it's like an obligation in our end. We issue it, but we have to buy it again, clearly an obligation. So in that case, if bought within 3 months or less, then part of near cash. All right, here are some examples of money market financial instruments. So we can just go over with that. And other items anyway have been mentioned by us. So example would be for US treasuries, we have the T-bills, notes, and bonds. We can look into the interest basis like discount for T-bills, interest bearing for both T notes and T bonds. And maturity, we can really see like 4, 13, or 26 weeks. 26 weeks that's divided by 4, that's 6 point something months. So it should be anyway again 3 months or less to be part of near cash, but that's still shorter. And then others, we can just look into these types of loans that we can avail of so that we can also get financing. So example, mortgages. So loans backed up by certain collaterals. But then it depends though, because some necessarily have collateral, some don't. It depends upon the situation. This is, by the way, on US perspective. Then bank financial instruments, we've mentioned about CODs, in which there's a definition and a feature, interest-bearing deposits at financial institutions. In the US, again, maybe fixed rate or floating rate, meaning the interest rate is constant or it can change or become variable. And also other bank financial instruments. The key again is it should be, or they can be, have, or they should have 3 months or less time to become part of cash and cash equivalents. We mentioned about that because again, these are the things that are very important about such. Also other short-term investments. So banking days would be considered. Money market mutual funds, through example, the mutual funds companies or through banks. Banks can also provide sort of funding on their end, and we can invest from such portfolios of bonds and stocks or shares. That's also one thing. For asset-backed securities, these are debt obligations that are having collaterals, not necessarily real properties, but also other assets like receivables. Remember about receivable financing, wherein we can make use of the receivables as collaterals of debt or financial obligations. And then in that case, we can have like assignment if the receivable is really being specific, or if it is as a general, like all receivables, any of the receivables, then that would be pledging. So those are discussed in your intermediate financial accounting and reporting, and many more. There are so many market financial instruments that we have mentioned here. We are just picking the important ones, and you can go over with such anyway. All right, so short-term borrowing. The cash manager has to ensure that the company has access to sufficient short-term credit because at the end of the day, cash position is important. So can we really pay our short-term obligations? Sometimes what we have would not be enough despite the efforts that we make to collect on time and delay the payment. So that's why we have to make financial obligations. So in this case, we have the so-called LIBOR or London, it's from London anyway. That's why it's London Interbank Offer Rate or Prime Rate. So whatever is the stated rate plus a spread or a certain added value. Then EBR or effective borrowing rate includes the total interest paid as well as fees paid. So this will be a computation in the later slide. So this is the formula. EBR is equal to this particular formula. So I need you to pause this particular part here and go over with the formula, familiarize in a minute or two, so that you can easily relate with the discussions later. At this point in time, you should be able to look into the formula. Again, EBR stands for effective borrowing rate, which is equivalent to the quantities first IR multiplied by AL. IR stands for our interest rate on this particular loan, for example, or short-term credit to be more specific or exact, multiplied by average loan outstanding. So in that sense, that is basically our interest. Remember, interest rate times principal amount, which is the AL, is that. Then plus our CF, which is the commitment fee. Commitment fee basically is the amount paid to the bank to make the money available. So it's like when we apply to a bank loan, we would say, we have this sort of commitment fee. It's not necessarily paid at that time, but it's like saying that should we be granted with this loan, then we are going to pay this particular amount. Or this can also be part of the deductions from the proceeds of the loan. Then multiplied by the difference of our total credit line. If we are going to negotiate with banks, normally we would be given the credit line that is applicable to certain factors that we are going to look into about the business. The minus average loan, so it's like the, of course, the amount that is still free over AL, average loan outstanding, multiplied by 365 over days loan, which is outstanding. If we analyze this formula, it's like converting whatever we have computed here to become annualized. So that's the point of multiplying this. We also have to take note that the IR, the interest rate, is periodic. So in other words, to be more specific, we can even extend this formula IR times AL to become the IR times the AL times the T or the time, in which that's going to be, for example, if it is based on days over 365, the numerator would be the actual number of days, for example, or if it is monthly over 12. But normally it would be in days because that's how we compute interest. Then another one would be example. We want to determine the effective borrowing rate or EBR on a 1-year line of credit with the following characteristics. So we have CL, total credit line of $500,000, average loan outstanding of $200,000, the commitment fee of 0.35% or 35 basis points on the unused portion of the line. This is banking practice and banking information. It would depend on a bank-to-bank basis. IR is the interest rate, 2.5% over LIBOR. So LIBOR or the London Interbank Offer Rate, this is British, currently assumed to be 5.75%. So in other words, the total interest rate, so that would be equivalent to 8.25%. The 2.5% is the spread over the prime. Prime is 5.75%. Then no compensating balances actually required. Since whatever interest that we earn from compensating balance, that would also be deducted from the formula, not to be added. So interest plus the charges of commitment fee, but minus the interest on compensating balance. And then year basis is 365 days. This is our computation. So substituting the values in our formula, And ironically, the numerator is 365 here for the second part of the formula all over the days loan, which is outstanding. That is over 365. However, let's go back to this. It's not stated actually like the time exactly, but we can see it is on a 1 year line of credit. So that's why number of days in a year assumed to be 365. That's the actual number of days. Business number of days is 360, but this is finance. We use the actual number of days. So with that, we can compute 8.775% as the effective borrowing rate. If we compare that with our interest rate of 8.25%, so we can see that the EBR is 0.50% or 50 basis points higher or above than the interest rate or IR as a result of the commitment fee paid on the unused portion of the line. So this is a good realization, whether we like it or not. If there's an unused portion of the line, there's a commitment fee that is paid. All right. So to summarize the discussions, cash managers are responsible for the following items: financial relationships, the forecasting of cash flows, invest or borrow, and the management of any investment or investments, short term normally. In managing collection, goal is to reduce collection float. We need to be able to minimize as much as possible with the float so that, of course, we can have shorter average collection period. Then objective for accounts payable is we are going to delay our respective payments of such, but without damaging the firm's reputation and credibility in the financing or financial community or in the business world. So no additional surcharges, no additional penalties or payments if we delay. Then cash manager will hold near cash assets in the form of short-term investment. That's true. Short-term borrowing obtained through commercial paper or lines of credit. We've mentioned that already. And that will be all for our discussions. Thank you very much for listening, and God bless us all always. See you in the next series of the videos.